We should all be paying attention to the 30-year Treasury bond. This is according to my next guest, who says it's key because it's the furthest distance from Fed manipulation. He is Peter Bookvar. He is the chief investment officer over at Bleakley Advisory Group and a frequent contributor over at CNBC. Peter, always good to see you.
Same here. Thanks for having me.
All right, so we need to pay attention to the 30-year Treasury bond. This is your thesis these days. Why?
Well, as you said in the intro, we know the Fed has obviously pinned the short end, and through the not explicit yield curve control, sort of implicit through saying that they're not going to raise rates for 3 years and talking about forward guidance, I figured you go out 30 years, it's the least impacted by what the Fed is trying to do on the short end. And even the 10-year, while I still pay attention to it, of course, it's still a good benchmark. It still sort of is getting dragged, or I should say, kept somewhat in check based on what the Fed is doing in the shorter end. So the 30-year, to me, from a market messaging standpoint, for looking at what the market is trying to tell you, I think the 30-year is probably the most effective messenger of that right now.
And Peter, you say inflation is a coming, but I want to tell you, I feel like it's already here. I mean, when I go grocery shopping every week, it's like I'm getting less goods and it's costing me more.
Well, it is here. One thing of interest is that when you look at the CPI index, putting aside rate of change, but look at the actual index that the rate of change is based off, is at a record high. So we've recaptured everything and then some in pricing of what was lost due to COVID. So the cost of living is at a new record high. And I try to separate the inflation basket between what we spend on services and what is spent on goods. And over the last 10 years, it was really the services side that reflected sticky inflation, mostly because of very persistent rent increases along with medical care costs. And goods deflation is what offset that. Now we're seeing, at least on the services side, some retrenchment because we're seeing rents, at least in the big cities, that are actually falling, and more of the suburban areas or population growth areas that are at least not going up to the same extent. Medical care costs still are very persistent, but it's the goods side now that is seeing the rise in inflation. And part of that is due to the services of transportation, shipping something, trucking something, putting something on an airplane is costing double-digit price increases more than it was a year ago because of the dramatic reduction in the amount of capacity and also that e-commerce demand. And you have also other parts of the goods side that is also showing some sharp rises in pricing, particularly used cars, for example. I mean, you had a couple of months of production that was shut down. So there's a lack of inventory in a lot of different parts. So it's costing more to entice people to produce and get that online. And overall, the whole supply chain apparatus around the world has been turned upside down by COVID. So throw a vaccine on top of this, hopefully some point next year, that demand side is going to come back much quicker than the supply side is able to meet that, both in goods and services. So I think, yes, I wrote is coming, but yes, I agree that it's already here. We're beginning to see the early signs of it. If you look at just even commodity prices outside of energy, food prices, multi-year highs, natural gas now above $3 for the first time since 2018, industrial metals that have been strong. All you need is crude oil, which I do think is going to happen soon because of the dramatic slowdown in production of crude oil will eventually show up in these inflation numbers.
So in this inflationary environment, where can investors find the best returns right now, Peter?
So I think playing the commodity theme, I think if I am right on inflation and right that interest rates will continue to head higher, you'll be wanting to avoid the high PE stocks, the overvalued technology stocks. The value stocks will trade better. Bank stocks probably will be an attractive place to be if the yield curve can steepen. So I think everything that has not worked over the past couple of years will work in this kind of environment, but particularly commodities, banks, and beaten up value stocks. So that will be a beneficiary of money coming out of the high PE stocks.
Did you say interest rates heading higher? Sorry, I thought because you were saying if you're right on inflation and interest rates heading higher.
Yes. So long-term interest rates, I'm expecting to continue to rise. So that should hurt the high PE, high price to sales companies, particularly in technology, and benefit those that have already been beaten up.
Okay.
But I think energy stocks actually is one of the most compelling investment cases for the next couple of years. And I argued in one of my notes the other day that energy stocks will outperform FANG over the next 2 years.
Okay. And also sticking to commodities here, thoughts on gold in this environment?
Big bull on gold and silver as well as part of this theme. I mean, I try to look at gold and silver as really just a function of two things: where are real rates going, and which obviously will be driven by where the inflation rate goes from here, and also what the dollar does and what other obviously fiat currencies do. And if I'm right on inflation and these CPI prints are going to be not just 1.5 to 2, but 2 to 3, 3 to 4, then real rates are going to get further, deeper negative. And you can be sure that the central banks and the Fed will be way overstaying their welcome with the easing.
Peter, final thought. I know you got to go, but final thought. If inflation, if we're in an inflationary environment and the Fed keeps, just printing money here, how does this play out? How does it end?
Well, it'll be the bond market that sort of takes it away. When I say take it away, it takes away the printing press and handcuffs central bankers. I mean, inflation is sort of kryptonite to central bank policy because it not only just limits any potential for further easing, but it forces them in the bad position of possibly having to tighten when they don't want to tighten, because the inflationary environment I foresee will come along with still modest growth. So there will be a stagflationary type feel, I believe, next year, even though I am hopeful for a vaccine. I do think that the economy is going to rebound, but that inflation story, I think, is going to be a problem for the Fed, because they've put themselves in this impossible situation where they've gone so far to one end of the easing that it's made it virtually impossible for them to seamlessly reverse that. And we saw that when they can barely get the Fed funds rate above 2% and when they barely shrunk their balance sheet. Can imagine when they try to do that now.
No, they've definitely put themselves in a very, very tight corner here. Peter Bookvar, I always appreciate your thoughts. Come on more often. Thank you for joining me.
Yep, we'd love to. Thank you so much.
And thank you for watching this edition of Stansberry Research. I will have much more for you, so be sure to stay tuned. In the meantime, we are on LinkedIn, Instagram, Facebook, and Twitter. We are there. You can follow us. For Stansberry Research, I'm Daniela Cambone.